In a world where financial emergencies can strike unexpectedly, many people find themselves searching for a quick fix in the form of payday loans. Promising immediate financial relief, these lifelines often seem like a beacon of hope during dark times. Yet behind the welcoming facade is an industry shrouded in controversy, one that weaves a web of debt and deceit, ensnaring those who are the most vulnerable. In this video, we'll delve into the underbelly of payday loans, uncovering their deceptive nature and the profound impact they have on individuals, communities, and the very fabric of financial stability. So join us as we expose this shady industry and explain why payday loans are not in your best interest. Welcome to Crucial Insight. To explain the concept of payday loans, they're essentially short-term solutions with steep interest rates, offering quick cash to people facing urgent money problems. They're designed to tempt those who are teetering on the edge, juggling paycheck-to-paycheck living, challenging debts, or grappling with poor credit scores. While they're often advertised as a financial lifeline, these loans carry substantial risks, and the payday loan industry has often been accused of acting in a predatory manner. This begs the question, why would anyone opt for payday loans when other means of funding are available? Well, it's usually a case of necessity rather than choice. People turn to payday loans for several reasons. Firstly, payday loans provide quick cash without the lengthy approval process of traditional loans. This is especially helpful when emergencies like unexpected medical bills, car repairs, or utility payments arise when a person is short on funds before receiving their next paycheck. The application process for payday loans is typically straightforward and can be completed online or in person within a short time frame. Secondly, those with poor credit scores might find it challenging to secure loans from banks or traditional lending institutions at all. Payday lenders often have less stringent credit requirements, making them seemingly accessible to individuals with bad credit. Thirdly, unlike many other types of loans, payday loans typically don't require collateral. This feature makes them appear less risky for individuals who may not have assets to pledge as security for a loan. And finally, some borrowers might not fully understand the terms and consequences of payday loans. They may be unaware of the high interest rates and fees associated with these loans, leading them to perceive it as a quick and simple solution to their financial woes. However, despite the immediate relief they promise, payday loans often come with exorbitant interest rates and fees, leading many borrowers into a cycle of debt where they continually borrow to cover previous loans, trapping them in a persistent and challenging financial situation. Prior to the 1990s, payday loans were actually extremely rare. Before then, salary lending existed in the 19th century, where employers sometimes offered advances to their employees against their salaries. Heading into the 20th century, the idea of short-term, small-dollar lending continued, with individuals and small lenders providing loans at high interest rates to be repaid on the borrower's payday. Then, between the 1970s and 1980s, storefront lenders, often termed check cashers, started offering small, short-term loans too. However, it wasn't until the 1990s that the modern payday loan industry took shape, and states began to legalize and regulate these loans. Throughout the early 2000s, the payday lending industry boomed, expanding rapidly across the United States and other countries worldwide. This was when online payday lending also began to gain traction. Shockingly, in 2023, as many as 12 million Americans were believed to have taken out a payday loan. The annual percentage rate, in other words, the total cost of borrowing for a year, was a whopping 662% in the United States, and around 1 in 5 borrowers defaulted on their loans. Worldwide, according to a Vantage Market Research report, the global payday loan market was estimated to be worth roughly $33.5 billion in 2021. It's no wonder that payday loans have been subject of much debate and controversy. A tug-of-war is taking place between companies providing quick financial solutions and governments trying to protect consumers from exploitative lending practices. The narrative is constantly evolving and is shaped by legal, economic, and social changes. One of the biggest criticisms of payday loans is that they are draining money from low-income communities. According to Vantage Market Research, certain demographics are far more likely to use payday loans than others. These include lower-income individuals, young adults who take out student loans, recent immigrants and individuals with no education, people without access to a traditional bank account, parents, especially those who are divorced or separated. On top of that, more than 2/3 of people who take out a payday loan are likely to use it for essential needs such as utilities, car payments, credit card payments, rent, mortgage payments, or food. So you can see why charging extortionate fees for such loans is considered by many to be in bad taste. The good news is that concerns surrounding the predatory nature of payday loans have prompted some states to enact stricter regulations and interest rate caps. In fact, as of now, payday lending is illegal in 12 U.S. states and has restrictions in 18 states plus Washington, D.C., where interest rates are capped at 36% or below. The Consumer Financial Protection Bureau, CFPB, started overseeing payday lending in the 2010s, aiming to protect American consumers from abusive lending practices. The Dodd-Frank Wall Street Reform and Consumer Protection Act gave the CFPB specific authority to regulate all payday lenders, regardless of size. In addition, the Military Lending Act capped interest rates at 36% for active duty armed forces members and their covered dependents. In 2017, the CFPB also introduced the Payday, vehicle title, and certain high-cost installment loan regulation, commonly referred to as the Payday Rule. Its primary objective was to impose more stringent standards on small-dollar lenders offering short-term, high-interest loans. Under this regulation, payday lenders were required to evaluate a borrower's ability to repay the loan before extending credit. What's more, it placed limitations on the frequency with which a lender could attempt to withdraw funds from a borrower's bank account. However, in 2020, the payday lending industry fought back, and the CFPB was forced to rescind certain provisions of the Payday Rule. Over time, the payday loan industry has faced numerous legal battles, criticisms, and accusations of trapping borrowers in cycles of debt. Yet by 2028, its global value is predicted to grow to $42.6 billion. The future of the payday loans industry appears to be at a crossroads. Ongoing discussions and potential regulatory shifts may continue to shape the industry. Meanwhile, stricter regulations aimed at curbing predatory practices and protecting consumers could impact the availability and terms of payday loans. Increased awareness about the risks associated with the practice, coupled with consumer advocacy efforts, may push for further reforms and alternatives that prioritize fair lending practices and financial empowerment. And of course, changes in the economy, including fluctuations in employment rates and income levels, can significantly impact the demand for short-term lending options. Overall, the future trajectory of the payday loans industry hinges on the delicate balance between meeting immediate financial needs and addressing the concerns regarding exploitative lending practices. As awareness grows and regulatory landscapes evolve, there will hopefully be a shift towards more sustainable, consumer-friendly lending options. While payday loans might appear beneficial for those facing unexpected bills or daily expenses, they often perpetuate a cycle of relentless, high-interest debt. Securing one payday loan frequently leads to acquiring multiple loans, resulting in a snowball effect where your debt accumulates and builds until it becomes completely unmanageable. If faced with unforeseen expenses or the need for financial support, it's crucial to explore alternatives to payday loans and strive to avoid them whenever possible. Numerous options exist beyond payday loans, such as credit card advances, personal installment loans, and specialized loans for individuals with limited credit histories. In contrast to payday loans, these alternative avenues generally offer more sustainable solutions in the long term. Regardless of your credit standing, they involve fewer fees and provide extended repayment periods. Although interest rates may be elevated for borrowers with suboptimal credit scores, personal loan rates are often capped at comparatively lower rates than most payday loans rate ceilings. If, after exploring all the options, you decide that a payday loan remains the most viable choice, be sure to familiarize yourself with the small print and your state or country's lending regulations. Remember, even if it seems like your best option, a payday loan is not in your best interest. Do payday loans have a place in society, or should they be banished to the shadow realm for all of eternity? Let us know your thoughts in the comments. Please leave a like if you enjoyed this video or if you learned something new. Make sure you subscribe to the channel for more, and thanks for watching.